Hi everyone, this is Jerry Chen from Real Estate Tax Tips, RealtorTaxTips.ca as well, your real estate accountant here. I've recently heard news about Realtor being allowed to incorporate, and all these companies, tax lawyers or accountants out there are all gearing up to set up corporations for real estate agents specifically. Realtors are now allowed to, will soon be allowed to set up corporations to own their real estate business in the corporations and enjoy the 12.5% income tax rate and the tax deferral available in a corporation setting, which is great news. The problem is that many people don't understand the process behind shutting down your personally owned real estate business and move it to the corporation. And today, the purpose of today's video is for us to go through that process and what's involved behind the scene. So let's get started. The first steps that you need to talk to is your accountant, someone that knows your business or someone that can analyze your business for you. Because in the eyes of CRA, when you when you transfer the business from your personal name to a corporation, there is a value being transferred from your personal name. You essentially sold your practice from your personal name to the corporation. If you don't do a valuation analysis to analyze whether your business is worth anything, it may trigger and file the appropriate form if there is a value attached to the practice, your real estate business. Then if you don't file the appropriate form, CRA could potentially come back to you and say, hey, like your practice is really worth $100,000, and then all of a sudden you have to pay tax on $100,000 sale of business in your personal name, and that kind of defeat the purpose of setting up the corporation and doing everything on the tax deferred basis. So we want to avoid all these unknown mistakes, and we want to be able to sleep at night. The first step is to do a valuation of your business. You may say, okay, my business is not worth anything. It's just me in it. I don't have a database, but you don't know until you do the analysis. And sometimes when you do the analysis, it's really just to satisfy CRA rather than really putting a value on your practice. So first step is to do a valuation analysis, determine if there is a value to it, and if there is a value to attach to your business. And if you have 3 years of businesses, you're already in 3 years of businesses and you're producing every single year, consistently making $200,000 annually, chances are there is a value attached to it. So once the valuation analysis is done, then if the accountant or the valuator decided, hey, there is value to your business, and if the amount is large, what we are going to do as an accountant is that we can tax-free rollover, file the proper form and do the tax-free rollover to sell the business to the corporation. Now, CRA may still disagree with the valuation report, but it doesn't matter because we have proper documents and procedure in place to minimize all the tax impact. There is no tax impact even if CRA disagrees with the valuation. Now, let's say we do the valuation, we file the proper form so that you can sell the business from your personal name to the corporation. Now, when you sell something, you need some legal paperwork done. So this is when the agreement of purchase and sale of your asset and the entire business comes in. And so you need the lawyer to draft up this agreement of purchase and sale. Now, we need to file the tax form, which we mentioned earlier. And then lastly, you can set up the corporation. The corporation set up on its own, maybe some lawyers out there are advertising setting up the corporation for $1,200. The reality is that corporation set up there is just one minor step. And even if you set up the corporation directly with a lawyer, you still need to have the proper share structure in place to make sure that you can maximize your tax saving. So this is the reason why this step is done by the accountants and the lawyers together. And there are so many different steps that we have to do before we can set up a corporation and transfer everything over to your corporation and enjoy the 12.5% tax. Now, the good news is that it's easy for us to do because we've done it before with other professionals, and so we would be able to help you to navigate this complicated process. The key here is to understand that it's not just as simple as setting up a corporation. It's also involving a valuation analysis. It includes an agreement of purchase and sale. There is some tax paperwork that has to be filed, and then at the end we set up the corporation.